Okay, welcome everybody. I'm just going to go over kind of like what I'm going to call an environment briefing. As always, this is not going to be about predicting where price will go or trying to guess trades because the EAs they handle the execution. So the role is obviously going to be much simpler than that, and honestly, it's going to be more useful. We just want to understand what kind of market environment we just move through. Because once you understand the environment, account behavior stops feeling emotional and it starts feeling logical and understandable. So think of this like reviewing the weather. We're not changing it, we're just learning how to interpret it. Because markets aren't random, they do go through phases, and each phase has a purpose. So today we're going to walk through the week last week, what happened, but kind of like as a story so we can get better at understanding it. So let's begin at the beginning of the week, obviously, in this level here. So this is where the Friday session finished, and this is where we opened. Now, it's important to understand that with this, it's important because the weekly open acts like a reference point. It tells us where buyers and sellers initially agreed price, and they agreed that price was fair at that point. So at the start of any week, markets are essentially neutral. Buyers and sellers are in temporary agreement, but price begins searching for imbalance. So that means one side's becoming a bit more aggressive than the other. So at the beginning of the week, the market's essentially asking, where should price move from here? So from that opening level, we can see buyers came in aggressively. They stepped in aggressively and price moved all the way higher to about 5,250. So this movement tells us that demand increased quickly. More traders were willing to buy immediately than sell immediately. So when that happens, price has to move higher to attract sellers willing to take the opposite side. Think of it like an invitation. As buyers rush in, price climbs until it reaches levels where sellers finally say, this is high enough. So during this move, the price was optimistic. The market was optimistic and it was directional. Movement was efficient, meaning price traveled further before pausing. But strong directional moves, they actually contain a hidden problem because markets move not because price wants to go somewhere, but because buyers and sellers are trying to find an agreement. So the problem is they often move faster than the agreement can form. And that when that agreement's missing, markets tend to correct. And that's what happened. This is what happened here. After reaching 5,250, price reversed sharply down to 5,094. And that's not unusual after strong momentum. When price moves quickly, many participants are left behind. Traders who wanted to buy earlier now see the higher prices and they kind of hesitate. So at that same time, early buyers, what do? They start taking profits. So that creates a bit of a shift. Buying pressure weakens and selling pressure increases. So the market essentially says, hey, we moved up too far, too fast. So let's start to test the other side. So this downward move was the market checking whether lower prices would attract the buyers again. It's really important to understand. Markets constantly test both optimism and pessimism. They move upwards to test how expensive participants will accept, the price they'll accept, and then move downward to test how cheap they're going to accept it. So that drop down to 5,094 was discovery. It was testing both sides of the value. Imagine an auctioneer rapidly raising prices and then suddenly lowering them to see where the buyers return. And that's what markets do. The fast movement in both directions usually means the market's searching for balance, not yet choosing a permanent direction. Now, notice what happened after price reached the lows. Instead of moving up again, it did move up slightly, but it slowed down, didn't it? We had these big candles, and the candles weren't then quite as big. And then the market, you can see here, started moving sideways. So if I put that down on the 1 hour chart, you'll see it way more clearly. I mean, look at this level here. It's just the market's pretty much just moving sideways in this range here. Okay. So what happens when it's moving sideways is many traders are just kind of losing interest. Well, I can't go this way. I can't. I'll wait until I see something move. But structurally, this area here, consolidation, where it moves sideways, this is where it's the market do their most important work. And look, the aggressive phase has ended. Neither buyers nor sellers had enough conviction to dominate. So the market's entering that balance. And now that balance just means that participants are transacting comfortably at multiple prices, up here, down here, up here, down here. They're agreeing more frequently. So again, that example we had of the auction, imagine where bidding slows because buyers and sellers are finally comfortable with a range, and this is that range. That's what happened here. The market's not confused, it's stabilizing. The participants in the market, they're reassessing value. So in simple terms, the argument or the agreement between buyers and sellers, it became more balanced. So we can see price moving repeatedly, up, down, kind of like this 5,200 level-ish and down to about, I don't know, 5,140, 5,150, up, down, up, down, up, down. There's no sustained direction. So what this telling us is this repetitive movement means that large participants, they're just adjusting positions rather than initiating the new trends. Some traders were exiting earlier trades, others are entering new trades, but the risk is being distributed throughout the market. That's why the range exists. They allow positions to change hands. So from the outside, all of this, what does it look like? It looks like indecision. The market doesn't know where it's going. But from the inside, well, actually, it's organization. Every movement inside this range adds a bit of information about where are the participants, where are they comfortable trading. And the longer this process continues, the more energy builds for the next move. It's so important. Like, you really have to understand that in this area, the market is not confused. It's just negotiating. Sideways markets, they often feel uneventful, but they're rarely inactive. Each swing within this range represents orders being filled and expectations are starting to form. And as buyers repeatedly defend lower levels and sellers repeatedly defend high levels, the pressure is starting to build. Think of it like compressing a spring. Everything appears small, but there's a massive amount of internal tension. And eventually, balance can't hold forever. One side's going to gain the advantage, and then price is going to expand again. So that's what happened. Towards the end of the week, price was holding this level, about 5,170 roughly, and then pushed up strongly to the end at 5,278. This was the release of accumulated pressure. Days and days, hours and hours, whatever it is, this agreement inside the range, then the buyers gain control so the price can expand quickly. And it seems sudden, doesn't it? That like big candle, it seems sudden. But it's being prepared in this range. This range created the conditions. The breakout, well, that just revealed them. Expansion creates imbalance. Balance restores agreement, so the expansion can happen again. I mean, let's go back to the 4-hour chart so you can see. Very, very simple. This whole thing played out exactly as we look at from the beginning to the end. The market began optimistic, beautiful. It was a corrective aggressively to test the opposite side. It stabilized and negotiated in the consolidation. And then there's enough stored energy, so then it renewed its momentum and moved upwards. Like, nothing random occurred. The market simply moved through its natural phases of discovery: expansion, reversal, balance, expansion, expansion, reversal, balance, expansion. So let's connect that to the actual behavior of the EA. So let me stop sharing the screen. What did you likely experience with your EA? Like during the early upward move, trades, well, they probably closed faster and more cleanly because price was traveling in one direction with momentum. And then during the sharp reversal, some trades may have closed more quickly than you expected. And strategies, because some of you are using stop losses, some of you aren't, but your stop losses may have been triggered more often because the direction changed rapidly. If you had a couple of trades in long and then it suddenly comes down, it's likely to hit those stop losses, isn't it? If you have a system without stops, maybe you're trading Gold Ninja, well, then you might have experienced some temporary increases in that floating drawdown because the positions were adjusting to the new environment. And then during the consolidation, where it was going sideways, trading activity probably felt busier but less productive. Trades open, trades close, probably a bit more frequently, but with smaller price movements. The profits weren't as big. Maybe you got more wins and losses. Maybe you got stopped out more because price was repeatedly changing direction. And that in an EA, that's sometimes where this phase often feels a bit uncomfortable. Not because something's wrong, but because the market itself isn't really progressing. But during Friday's expansion, it went off, didn't it? Movement likely became cleaner again. Trades then resolved more decisively because that directional momentum returned. So in short, different market phases produce different account experiences, even when the system itself remains unchanged. So what are the expectations for this week? After a strong expansion, like we had that strong expansion at the end of the week, we've seen markets either temporarily hold or they reverse because the participants need to reassess the value at the new prices. So we're not going to predict direction. It just simply means the market may alternate between movement and consolidation, or it may continue. It may have a continuation. The goal is not to forecast, but it's to remain prepared for that changing tempo. So what we've got to remember is markets are dynamic environments. They accelerate, they correct, they stabilize, they expand, but no single phase lasts forever. There is no perfect condition. So we've got to succeed not by predicting, but by remaining consistent through them. Our edge comes from stability, not reaction. Last week was not a random movement. It was a full market cycle unfolding step by step. Expansion, correction, balance, expansion. Nothing abnormal occurred. The market simply changed pace. So all we've got to do for this week, let the system continue doing its work, remain consistent, and then we'll review the environment together again next week. With that, have a great trading week.